you look at the wealthiest people when they go into the private banking world, they're never selling their assets. And so they're borrowing against their stock portfolio, they're buying just like you would borrow against your house. And that's the way for them to continue maintaining appreciation of existing assets, but buy additional assets as well.
The game is to build assets, not sell assets. If I'm borrowing at 15%, what am I doing with that money? So a lot of times I think people look at borrowing and it's like, oh, I'll borrow against it and I'll go on a vacation. And maybe you don't want to pay 15% for that. But if I'm going to buy a new truck for my business, that's going to make me much more than 50%. It's probably a pretty good deal.
Let's say you were borrowing just to spend on a vacation. If what you were going to do instead was sell Bitcoin to pay for that vacation, maybe borrowing actually works out. Even though you're using funds in something that doesn't appreciate at all, you get to benefit from the appreciation of the asset that you otherwise would have lost out on if you sold.
A lot of the risk that people see is because they have PTSD and they were burned from the first round of Celsius and BlockFi. What do you think about that in regards to like the risk that people are suffering from?
You have to understand why these companies failed or what went wrong there. And there are really a few key problems. One, it was more mismanaged. The second was poor underwriting practices. And then the third was more just fraudulent activities. If you see a loan below the federal funds rate, like you should have flags in your head. Something is happening that's not right, or they're doing something with your Bitcoin that you don't know about.
All right, Dhruv. So let's dig in, man. There's so much to talk about. Let's talk about, first of all, some of your background. So before coming into Bitcoin, you were in San Francisco, sort of in the hub of the tech space. So sort of give me your background in the tech space and kind of where you got started.
Yeah, so actually, I grew up in the Bay Area, but I started my career at a hedge fund at Bridgewater Associates, where I was a quant in the research department. And that was interesting, just trading different financial asset classes and understanding really what moves markets. From there, I went to San Francisco and joined an early stage fintech company called Brex. That was fascinating for me, just seeing the rise of a company that was successful, creating financial products for other businesses. And along the way, I was investing in other startups, investing in Bitcoin, and just saw firsthand how traditional financial services players, mostly banks, won't give you credit against these assets. They actually don't even deem them as creditworthy. Yeah. And that really just sparked a moment in my head where I was investing in these asset classes, but everyone around me was as well. And so this was a growing group of people that were more and more alienated from traditional financial products. And that really led to the genesis of Arch, which is what I'm working on now. And really our focus is to build a wealth management, private banking like company for alternative asset investors, mainly like Bitcoin focused.
Yeah. You were a quant at Bridgewater?
Yes.
Yeah. And what were you focused on there?
There, so the way it works over there, I was in the research department specifically, and you're building these systems from the ground up. So taking in data, so we would scrap government data on a variety of different metrics like inflation, growth, household investment numbers, things of that sort, and try to model out, okay, if the government gives you lagging data, how can you best then go and predict what that data might be like a quarter out or even, further out? And then from there, start to build a mental map of, okay, these two data streams put together might give you a sense of how the equity markets are going to move. And then you can use that to trade off of that. Right. So for me, it was really a lot of times figuring out how do we get the best source of data and how do we go from historicals all the way to what do we think inflation is now and what it might be in 3 months.
How much of that do you still use today to think about the direction of your company?
Yeah, interestingly enough, a lot of those principles are still very relevant to what I do today, especially when we think about the macro, where do we think interest rates are going? And as a result, how can we price loans or how do we think asset prices might move? So I'm not in the day-to-day of maybe predicting all of these things, but it's very helpful to have that understanding because that influences everything we do in the lending space.
Yeah. Well, what do you think that where things are and where they're going to go?
Yeah, it's really interesting. I think we're at a point where when we look at where interest rates are, we've had slow rate cuts. And I think everyone is looking at the underlying economy. It seems like maybe dual fold where you see employment numbers are coming out quite strong, but also you're seeing price of goods remain quite high as well. And so it's unclear. It seems like the Fed is looking at holding steady for a little bit and just seeing how to proceed here. But for us, when we think about this, what that does is as you have a higher interest rate, the cost of borrowing is always just going to be higher than usual.
Right.
And I think that is the key thing is as that starts to come down, we'll start to see more people borrowing and more capital inflows in the space.
Yeah. Now, I have something that I've said many times and something that you referenced earlier. And I think about in the game of building wealth, which certainly is not the highest and best use of our life here on earth. But in that game of building wealth and building assets, most people seem to maybe have this entirely wrong premise of, well, maybe they don't even know they're in a game, what the rules of the game are. And I say, as I've been asked 100 or maybe 1,000 or maybe more times, when Bitcoin's 1,000 or 10,000 or 100,000, Mark, when are you going to sell your Bitcoin? And I'm like, well, you just don't know the game we're playing. The game is to build assets, not sell assets. One of my good friends, his grandfather did an amazing job, 100-year-old company, bought assets all over from warehouses to beachfront properties. And my friend now he died and he sort of is running all that. And a lot of the heirs, they just want to go sell all the assets.
Yep.
Let me get a bunch of cash and I guess go spend it all. But it's like, that's not the game we're playing. You had said something earlier where you've sort of had this different thought process of trying to build assets and then leveraging those assets for more assets. So most people don't understand that. They think they want to buy the asset and then sell the asset. But you talked about buying an asset and selling or leveraging the asset. So tell me about that game and how you kind of came into thinking like that.
Yeah, I mean, I think this is your world and you speak very eloquently on this topic. But for me, it started just from my background. My grandfather started like a family business out in India and my dad was an entrepreneur as well. And so I've always seen the way like they think. And it's mostly always like, how can you accumulate assets? And debt is not a bad thing by any means. And so for me, that sort of shaped my worldview early. And it's always, if you look at the wealthiest people when they go into the private banking world, which a lot of people just don't have a view into, they're never selling their assets. They're borrowing. They have what's called equity lines of credit. And so they're borrowing against their stock portfolio. They're borrowing just like you would borrow against your house. And that's the way for them to continue maintaining appreciation of existing assets, but buy additional assets as well. Now, don't get me wrong. There's risk anytime you continue to add leverage, but you can do so in a very smart way, taking on a reasonable amount of borrowing against your existing assets, but then use that money in a positive way where it's not you're blowing it on some vacation or something, which could be reasonable also, but you're using that to buy another appreciating asset. And so, my worldview here was sort of shaped from just how I grew up, but also then seeing it in other people around me, where if you ask executives at other tech startups what they do with their money, you'll see a lot of them are very savvy and borrowing against maybe equity in a business or things of that sort to continue to, grow their wealth.
Yeah. I mean, you're younger than I am. What have you seen? Like you mentioned, like your grandfather in India. I remember my grandfather, what my mom would always say, and my grandfather would always say, just buy land, buy land, buy land. And my grandfather owned a bunch of land and a bunch of like good lakefront properties, hunting properties, things like that. My friend's grandfather I just referenced bought all this land, your grandfather, et cetera. But today, the younger generation doesn't necessarily think like that. So do you think that's like this debt-based monetary economy, or is it just maybe our culture's caught into short-term mentality? I mean, have you noticed that like difference between our grandparents, and the generation today?
Yeah, I mean, it's huge. I think one word that I might be able to like succinctly summarize it with is maybe delayed gratification, where it seems like my grandparents and that generation was more so fine of, okay, I'm going to like maybe make investments that I might not even bear the fruits of the labor for. Maybe it's the next generation, things of that sort.
Yeah.
And now with social media and all these things, you want instant rewards, and as a result, people are more so thinking about how do I live now and maybe spend now, and future decisions are sort of more put off.
Yeah.
And as a result, you tend to lean towards, okay, what can I sell now to get cash, as opposed to how do I play like a more structurally long game?
Yeah. Yeah, there's just such a different mentality that we could learn from our grandparents, for sure, our elders, that I just don't see today. So you mentioned earlier, like leveraging assets. So like, when you sell an asset, then you no longer have the asset, so then you no longer have the appreciation from that. Whereas like I could borrow against that asset. I still have the asset to go up. Now, a lot of people don't understand how this works, but I'm like, we're in a debt-based monetary economy. You can basically borrow against anything. I could take a Rolex watch to the pawn shop down the street and get a loan against it.
Yep.
Car title loan on my car. I mean, we can get loans on anything. Even most banks will loan against my equity portfolio. I mean, this is you mentioned earlier at your job, like you had these assets that you weren't able to get a loan against, but I mean, isn't the debt pretty freely available today?
Yeah, so it is, just depending on the assets that you have. And so let's put it this way. You can go, and most people that own homes have a mortgage against it, so they've borrowed some portion there. If you bought a car, sometimes you have a car loan there, so you have debt. Many people have debt on a credit card. You just don't think of it in that same way. You can get a personal loan, but there's some assets out there, Bitcoin being the main one that comes to mind, equity in businesses that banks just don't understand as much. And so as a result, if you happen to have wealth denominated in these assets, you're more stuck to, okay, what can you get with your credit score and your income, which might not be as high as your asset base. And so you sort of have a bifurcation of banks don't view those as assets, and they're trying to underwrite you in a traditional box.
Yeah. So when it comes to borrowing against Bitcoin, I mean, very back of the napkin math is you have an asset that's been averaging 50 to 60% CAGR, annual growth rate over the last 4 years, and I could borrow against it. Anything that I could borrow against it paying less than the 50 or 60% seemingly would be a good deal.
Yep.
Recently, I made a post, I think you saw it on Instagram and Twitter, where I bought my daughter a car, and I was thinking about paying cash. Just rewinding the clock, I had multiple business exits. I had built up a giant real estate portfolio. I built this building here. In 2008, I got wiped out, and I had massive PTSD. So for like several years, I'm like, there's no credit.
Yeah.
And so sometimes I still default to like, I'll just pay cash for that car kind of a thing. But they offered me a great rate, right? It was like 5% for 60 months or whatever. And I was like, I'll just buy the Bitcoin. I can leverage the loan. And so I think about, well, if I can earn 50 or 60, and even if I paid 20, that'd be a good deal.
Yep.
Right. But yet there's like still risk. And a lot of the risk that people see is because they have PTSD and they were burned from the first round of Celsius and BlockFi, et cetera.
Yeah.
So what do you think about that in regards to like the risk that people, are suffering from?
Yeah. I mean, I think you articulated it correctly, right? There is a lot of PTSD from the prior crop of lenders. And I think to really lay out the risks here, you have to understand why these companies failed or, what went wrong there. And there are really a few key problems. One is the rehypothecation of people's Bitcoin. Now, rehypothecation in and of its thing isn't a bad thing. Like it happens in traditional financial markets all the time. When you have stock at a brokerage, they might be rehypothecating it and doing other things with those stocks. But in crypto, or at least in Bitcoin specifically, what was happening was it was more mismanaged. Like it was going to counterparties all over the place. No one was actually doing diligence with the risk and what was happening, what people are doing with their Bitcoin. And so as a result, like some companies went under because somebody else just had their Bitcoin and lost it, whatever. There's a whole host of reasons why that occurred. The second was poor underwriting practices where people with even doing Bitcoin backed loans were doing one-to-one collateralization or saying, if you want a $100,000 loan, just give me $20,000 worth of Bitcoin. And you can see how the math sort of goes upside down there. And then the third was more just fraudulent activities, which you can assume happens in many industries, and that is more like a one-off bad actors. But really, it was rehypothecation and mismanagement of underwriting and risk. And for us now, and I think how do you move this industry forward? You really have to be transparent and address both of those head on. And so what you see now is a new crop of lenders, us being one of them, that is very clear about not rehypothecating. In fact, we will actually even segregate your assets on chain and send you the address. So you can look up at any point in time 24/7 knowing this is the exact amount of Bitcoin, nothing else has come in or out, and sort of helping move the industry forward with that. And also working with regulation. I think being regulated in various states, having the appropriate licenses, all of these things are great ways forward. And then also the financial risk management. So making sure everything you do is over collateralized. You're only accepting Bitcoin and blue chip assets if you do other things outside of Bitcoin. But I think all of those are some of the key things that were learnings from the last cycle.
So with social media, we learned if you don't pay for the product, you are the product.
Yep.
Right. So I'm not paying for Facebook. I'm not paying for the product of social media, but I am the product. So they're harvesting my data. And what you saw with those Gen 1 companies, if you want to say that, right? Where like you were getting 1% loans.
Yep.
So it's like if you're not paying for the loan, you are the loan kind of a thing.
Exactly. Like as a rule of thumb, if you see a loan below the federal funds rate, like you should have flags in your head. Something is happening that's not right, or they're doing something with your Bitcoin that you don't know about. And then as a result, anything further above that makes sense with financial assets, right? Like you have mortgages that are priced on top of federal funds. Everything is more so a spread on top, and Bitcoin should be as well. Now the current spread is more so than what you and I probably think it should be. But yeah, if you see rates that are very low, even like near federal funds rate, your head should, have alarms ringing that something else is happening that you might not be aware of.
Yeah. So then that you were the product, so they were loaning that back out. So they were trading with that, which caused undue risk. Then poor management, again, undue risk. So then they put the company that you gave your money to did a lot of risky things with it. The problem though also was that when the risk caught up to these companies and they eventually went under, but a lot of people found out that they didn't own that Bitcoin. So that was a problem also. So then through bankruptcy proceedings, it belonged to the company, not them. That was a problem. You also mentioned regulation, so you're being regulated, and that's also something. But like BlockFi, for example, was like heavily regulated.
Yeah.
Right? So the regulations weren't necessarily risk prevention. And then there was the custody problem.
Yep.
So how do you think about those two things?
Yeah. So regulation, I think, one, it's dual-fold of also regulators evolve over time as well, right? Like when it's the first time, they're also seeing, Bitcoin-backed loans for the first time, not truly understanding what like rehypothecation could look like, things of that sort. It's easy to see why, okay, like maybe you have your licenses, but still there are certain aspects that might have been overlooked. And I think that will continue to get better as well as everyone learns. With respect to custody, I think there's two pieces here. One is, in honesty, it's hard to lend against Bitcoin not having custody, right? You're just saying, look, like I know you have these assets, I'll lend against it, but I don't have any downside protection because that's the only thing I'm lending against. So if Bitcoin does drop, there's no way I can go and liquidate a portion of it just to make myself whole as a lender. Mm-hmm. So you need some sort of like custody model. One can be multi-sig, and we've seen that. Now, even with multi-sig, you'll realize that 2 of the 3 keys are not in the borrower's possession. And so there is, it's sort of more, there is risk there, like other people can move your Bitcoin without, even though you have one key.
One key does nothing in a multi-sig.
Exactly.
So really what you do is you have visibility to the account, but you have no control of the account.
Exactly. And I think like, we have done that same approach, but in a different model where we partner with Anchorage, that's a federally chartered bank. And we have the custodial ownership, meaning it's transferred. Title still remains to the borrower. So it's not like we're taking title of the assets, but we segregate them and show them the on-chain address, which mimics a multi-sig with just one key where you can go look up your account. I think as this space evolves, those setups will evolve as well, and be in a place where, one, you can have both comfort to the borrower, but also the lender saying, look, like, that these are your assets. I also have the ability to sell them if I need to, but it's not that full ownership is maybe transferred, things of that sort.
But what about in some sort of like a bankruptcy proceeding? How does that chain of ownership go?
Yeah, I think bankruptcies are the hardest to comment on just because each one is so unique. What I will say is the way we're set up is we have raised capital in a very traditional financial structure. So if anything were to happen with Arch as well, we have in the financial structure we've raised with Galaxy, we have a backup servicer that would step in and continue to service these loans on both the cash side and the Bitcoin side. So what you'd see is 2 different entities that would step in. One would continue to process your monthly payments, and the other would continue to make sure your Bitcoin loan is in good standing, margin call you, liquidate if needed, and also process the return of your Bitcoin. And so I think that's one other thing that has evolved in the industry is also what happens in these events. You can plan for it. You can't, you can't ever predict how something like that will play out. But this happens in many traditional financial lenders where they have backup servicers, they have things in place should something go wrong.
Yeah, I mean, we certainly saw that in 2008 through the mortgage crisis where a lot of the banks that had the paper went out of business, and then it just got assigned to another servicer, and
Exactly.
someone else bought the loan, and then they serviced the loan.
Exactly.
Right, and there was like really no change in the person that owned the house and made the payments. It just on the back end it changed.
Yep. And so that's one thing we've done here, and are hopefully trying to like pioneer and push forward the industry with sort of hygiene of lending practices.
Yeah. What do you think about banks? And it seems like banks have seen this party happening and they've been sort of left out of it. We know that last year the banks tried to overturn this rule that would allow them to custody Bitcoin and crypto assets. Biden himself vetoed that bill. My guess is that probably gets resubmitted. I'm sure the banks want to custody that. The Trump administration probably greenlights that maybe this time, or maybe it doesn't even go that far, but it probably happens. I mean, do you look at the banks, I guess, one, do you think they want to get into this? It seems like they do. And two, does this seem like maybe an area you think that they're going to try to jump into?
Yeah, I think it makes sense for banks trying to get into this. One of our customers actually owns a regional bank, and I was on the phone with him, and he was telling me like, yeah, they see outflows to Coinbase and all these other exchanges and crypto companies, and so for them, they definitely want to have a part of this. I think custody is the first natural step. Now, what I will say is it's not easy to build a custodian. You've seen many crypto companies try and do it successfully and wrongly, and it takes a while. But it makes so much sense that like the larger ones, Goldman, JP Morgan, et cetera, would do it. It's unclear whether they will buy or build in-house or partner in some capacity. But I think over this next year, we've already started seeing headlines. I think Bank of New York Mellon is either working on or has announced.
They're the one that got through the cracks somehow.
Yeah, exactly. Them. I think State Street they've like announced a few different times and then pulled it back, but I think they're looking to get into the custody space. Goldman as well. A lot of these folks are also investors in like Anchorage, BitGo, and other custodians. So I think yes, they will definitely get into the lending space and probably over the coming years move beyond that as well.
Yeah, I mean, it seems like it's a natural step. However, at the same time, you don't necessarily think of like your commercial bank down the street where you have your checking account as someone who would loan against your other assets.
Yep.
Maybe most of them do mortgage loans, for example, but maybe don't do equity loans. Or when I say equities, stocks and things like that, right?
Yeah, that's right. I think like the first step is custody, and maybe that's where the focus will be for the next couple of years. Lending is like a derivative on top of that. To your point, most banks you don't even think of as like lenders beyond maybe your personal loans or a mortgage. And I think that will probably continue. And perhaps banks work with other customers in like a white label manner to offer lending. Most banks aren't even offering stock-based loans. It's the big brokerage houses that do it. And so I think we have a ways until people start to see if banks dip into that space.
What do you think about like more algorithmic or smart contract based lending, where then you don't have the custody issue where maybe it gets locked up in a smart contract or something like that?
Yeah, I think, look, those make sense as well. It's different profiles of customers in my mind. One, and maybe part of it is a facet of how those products currently work. I would say the first things is you have a different set of risks. You have smart contract risks, which have happened. You've seen, DeFi protocols get hacked, things of that sort. The second is they're all variable interest rate products. And so what this means is it's hard to plan a longer term loan against a rate that varies all the time. Like even, I believe in Aave, where they lend against wrap BTC, they've had rates go up 20% and more in bull markets. And so that is another aspect. And then the third is the sort of customer experience. I think a lot of people with the current user experience are uncomfortable sending funds out into the ether, not knowing, hey, like what happens if something goes wrong? Can I call up a person, et cetera? Or you get liquidated overnight, no notification, no nothing. So I think a lot of the issues are around usability, and a lot of it also with how that product works, where you haven't seen, at the end of the day, lending also needs debt capital, right? So you need large pools of capital to come in and provide a company debt. Banks have that naturally, but with DeFi protocols, they often rely on retail capital, and that can be finicky, which causes a lot of the interest rate differences.
Yeah, good points. I think about there's no such thing as no risk, right? So it's all just trade-offs. I could go to the gym and get hurt at the gym, or I could sit on the couch and then I have risks of not going to the gym, right? And so I guess, where do people feel comfortable taking that risk? Would I feel more comfortable dealing with a company that I see regulated, or some internet protocol that I don't really know who built it or how that runs? I'm not sophisticated enough to know how to check that protocol, for example. So definitely different types of risk there. When you talk about lender capital or available capital markets, again, I mean, I think like in a debt-based economy, obviously we had like a decade of zero rates.
Yep.
Rates are much higher today. You know, the Fed rate is pretty attractive to a lot of people. Does that make it harder to raise capital for these debt markets?
Yeah, I think what it does is make it more expensive. And what I mean by that is, when the base interest rates are so high, what you see is large pools of capital making good money just lending to public companies or lending to other assets that they know are sort of high yielding and relatively safe. So for example, even mortgages right now are around like 7 to 8%. And as a result, if you go to a sort of lender and say, hey, I want to do Bitcoin backed loans, you are going to be deemed more risky than like a mortgage, just given the history of that product. They understand that. And so now, instead of 7 and 8, you're maybe sitting at low teens. You see stock-based loans, even at some brokerages, showing like a 12% loan. And so what it really does is, one, it makes it harder, but second, it just makes it more expensive. And so I think those are the two ways you
harder and more expensive go hand in hand.
Yeah, exactly.
Right? So there's plenty of capital out there if you're willing to pay for it.
Yep. Yeah, but the thing is, I think when you flash, just given we were in 0% interest rate for like a decade, when you show people, hey, I don't know, 15%, people naturally just step back and say, whoa, this like feels very expensive. Let me just hold off. As opposed to, some of the math that you were doing, where if you're borrowing against an asset that's appreciating well north of that, that decision is pretty easy every time.
Yeah. I mean, this really goes into the sophistication of the borrower. So you have on one side of the aisle, you have someone like Dave Ramsey, who, potentially is maybe, arguably one of the biggest personal finance guys out there, at least publicly, right?
Yep.
And Dave Ramsey's mantra is never use debt. Never use debt. Pay off any debt you have. Don't use debt. My friend Robert Kiyosaki, he says that he's on the opposite side of the table, where he's like, hey, I'm $1 billion in debt. Great. Donald Trump was called the king of debt, right, in his career. But Robert Kiyosaki says that Dave Ramsey is right for most people, because most people don't have that sophistication built up to understand this, right? So there's like different ways that I would look at that rate, right? So number one is like, is it worth me borrowing at 10, 12, 14, 15%? Well, it depends. How much am I making with it? So when I was really heavily in building real estate, and I've been involved for a long time in like hard money loans. So I might, be able to get a mortgage loan at that time for 4 or 5%, but I might pay 12% for hard money. But if I'm going to make 50% on the deal, I'll pay the 12%. So it really comes down to like, how much am I going to make from borrowing? So if I'm borrowing at 15%, what am I doing with that money? So a lot of times I think people look at borrowing and it's like, oh, I'll borrow against it and I'll go on a vacation. And maybe you don't want to pay 15% for that. But if I'm going to buy a new truck for my business, that's going to make me much more than 50%. It's probably a pretty good deal.
Definitely. And there's alternatives, like let's say you were borrowing just to spend on a vacation. If what you were going to do instead was sell Bitcoin to pay for that vacation, maybe borrowing actually works out. Even though you're using funds in something that doesn't appreciate at all, you get to benefit from the appreciation of the asset that you otherwise would have lost out on if you sold. So yeah, I think a lot of it is the sophistication of the borrower. There's a lot of education that needs to be done here, just to even show people what they can do. I think when you talk about borrowing against your assets, it's very vague, but if you can make that concrete and say, look, here's an example if you invested in real estate and how the numbers play out, people can start to wrap their heads around that.
Yeah. Obviously, I'm big in the education space, so I am, of course, agreeing with you. I think about in sort of a way to look at this in real estate, as you mentioned. So if I make $1 million, I can pay half of that to taxes, and I have $500,000 left. I could, back in the napkin math, buy $1 million piece of real estate with $200,000 and get $1 million of write-off.
Yep.
And so a lot of people look at the real estate market and go, oh, if it drops 20, 30%, all these people are underwater. It's like, dude, I just saved $1 million in taxes. What do I care if the property drops by $200,000? I don't care, right? And so again, that's sophistication. And if you think about sort of Bitcoin in the same way, where it's like, I want to borrow, but it's 15%, but I can't make 15% with the money. I'm only going to make 5 or 6%. Okay, well, that's one way to look at it. But if the asset's going up by 50 or 60%, does it offset the difference I'm paying? That'd be one way to look at it, right? A more sophisticated way. The other way you could look at it is if to your point, my other option might be to sell the Bitcoin to get the cash, but now that's a taxable event, so now I have to pay the tax, so now I've lost some there. And then, of course, I no longer have that Bitcoin going up in value. And so it gets a little bit more complex in how I have to like calculate that out, which is why Dave Ramsey's right for most people. They don't understand that, but I guess this is one reason why you see the sophisticated people making the rich getting richer and richer and the poor not.
Yeah, exactly. I think like it stems down to really just education. I think you do a lot of good work, and so do other people, on just helping illustrate this. I've actually had customers of ours email me saying, "Hey, I saw this like video of Mark Moss on like retiring against with Bitcoin and how you can strategically borrow." And you know, things like that are needed. People need to see, okay, what can I do? How can I make my current asset base work for me, as opposed to always just defaulting to sell. Now you pay taxes and you're really left with like much less than you otherwise would have.
Yeah, yeah. So where do you see Bitcoin going? Do you factor that into your business? Because like Bitcoin has historically had these 4-year cycles.
Yep.
Until proven otherwise, I think they continue. We can get into that, but more on the macro side, I think this 4-year cycles aren't just because of the Bitcoin halving, which certainly is a piece of it, but it's really the liquidity 4-year cycles that we have. So debt cycles globally are sort of on that same cycle. So it seems like that continues, and that could be very dangerous when you're borrowing, right? So do you take that into consideration as far as like the loan orders, or is that just up to the individual person to sort of like educate themselves on that?
Yeah, I think we try to help as much as possible here. And the main way to do it when you think about volatility of Bitcoin is, one, be very transparent about what happens. And so you will not take out a loan with us without knowing exactly at what price you're getting margin called, at what price there's a liquidation. And we notify you even well before that. We're sending emails, we're calling, and just letting people know like, hey, our goal is to help you keep your Bitcoin. Like we're got into this business to help people get cash and keep their assets. And so we do not want to be liquidating customers without them being aware of it and saying, yes, I'm okay with this.
Right.
And so as a result of that, one, we have a long ways to go to keep putting out more educational content. But second, we also tell customers very clearly, you can decrease your loan to value. You can be more conservative with the loan amount you're taking with respect to your Bitcoin. And then obviously there's all the white glove customer service that we have on our side, just calling up customers, emailing them, letting them know if anything is, unhealthy with their loan state.
I'm curious from a company standpoint and your projections for growth. I would assume a lot of those projections for growth would come to basically down to the projection of where Bitcoin goes to. I've been very outspoken. A talk I gave in Abu Dhabi here recently, I said that I think Bitcoin would be $1 million by 2030, 15 million by 2040. And so obviously if Bitcoin does follow that trajectory, there's going to be a lot of locked up equity, which then would lead to more customers that might want to tap into that locked up equity. I'm curious your views on that and kind of how you think about that with your company's growth.
Yeah. I don't have specific price like targets, but I think roughly in line with what you're saying in terms of I expect Bitcoin to continue going up and to the right. And what that really means is growth in the soaring like borrowing industry. More and more people are going to have equity tied up in this asset. They don't want to sell Bitcoin. And here are ways for them to get cash and continue to own their Bitcoin. Also, when you look at it, I can't remember the exact statistics off the top of my head, but Bitcoin as an asset class has a very lower level of borrowing against it relative to many other assets, like when you think about like houses, gold, things of that sort.
Right.
And so one, even at current price levels, there is a long way to go. And I think part of it is education, part of it is just people becoming more familiar with the space, companies like us evolving from the generation one that blew up and continuing to sort of exude trust for customers. But then the second is, as the market cap of Bitcoin continues to go up, naturally more and more people are going to borrow. And so I think the whole industry grows together there.
Yeah. Okay.
And we see it like as Bitcoin pricing moves up, you see borrowing demand sort of go up as well.
As it should.
Yeah.
Don't sell it.
Yeah, exactly.
Leverage against it. I mean, that's the mantra that I'm trying to get through people's head. Don't give up your Bitcoin, right? So, as more equity's there, I mean, tap into it as you need. Cool. Well, let's wrap this up. Maybe just kind of recap. I know we've kind of covered this quite a bit, but if you were talking to a friend or your mother, and she wanted to tap into Bitcoin, and you were a little bit unbiased, what are the considerations that you think people should, if they're going to go look for a company?
Yeah.
What things should they be looking for? What are the trade-offs and risks that they should be looking out for?
Yeah. So maybe I'll stick. I'll look at both decentralized and centralized companies. So I would say on the decentralized side, one, make sure you're comfortable with sending funds out into a protocol. If you can, do your diligence there and just understand the risk, the team behind it, things of that sort. And just be ready to monitor that loan a lot more actively, because you don't get notifications, you don't get any sort of margin call notifications, things of that sort. And lastly, know that your cash will be in crypto and stable coins. And so if you have real world use cases, that will be an external hop for you. On the centralized side, I would say things to look out for: rehypothecation. Just whether or not it's okay with you is a different story. Just you need to make sure you understand what the company is doing, if anything. The second is due diligence on the company. What if they have licensing, how long they've been lending for, their reputation. You can look up reviews of companies. I think there's many sites that people review these businesses on. Lastly, just the experience that you have with the company. When you try to make an account, can you get a hold of the people behind the company? Things of that sort, I think, matter. How succinctly they're able to explain to you what their business model is. Obviously, look at the rate. Not that a low rate matters, but a very low rate should trigger alarms in your head. These are the key things I think what I would look at.
How many states are you? Is Arch Lending regulated?
So for consumers, we are operational in 31 states, and then for businesses, it's I think 40.
What's the roadblock to getting all 50?
Yeah, so I think it's just working with the state regulators and going through the lending license application. So California is notorious. That's one we're not live in, either for individuals or for businesses, and it takes about a year. So I think we're expecting to be live in California probably by the end of this year. Mm-hmm. And the main hurdle is really just going through the application process, putting together all the material, but working with the regulators and having that back and forth. And a big chunk of the time is actually them processing the applications. They have backlogs and things of that sort.
So it's mostly just a matter of time?
Yeah, I think it's a matter of time. Is so long as you're, as a business, are capitalized. They look at the financials of the business, things of that sort. But a lot of it is just timing. They need to process the application, ask questions, make sure they understand the model as well.
Yeah. Okay, cool. Anything else that we should cover? Anything else you want to say to wrap this up?
No, I think we covered a lot of it. I'm looking forward to seeing more of your educational content out here in this space and seeing how we can evolve it together.
Great. All right, Drew. Appreciate that. We're going to go ahead and link to everything down in the show notes down below. That's what we got. Thanks so much.
Thanks, Mark.